Good morning, ladies and gentlemen. As I said, I'm going to tell you a little bit about how we see things moving forward in the UK construction industry over the next couple of years. As an outset, it might, we heard earlier on about how data is important. Well, Glenigan has a lot of data as well, but of a slightly different hue, shall we say, much more economic market data. And it's that I draw on, or we draw on as a team, when we're analysing really where the market's going and where the opportunities are going to be over the next sort of 2-3 years, really. Glenigan as an organisation, we are trying to identify everything that's being planned and being built in the UK, trying to identify who's building what where. Now, clearly, the main purpose of that for our customers is to get involved in those opportunities, to find out who they should be speaking to win work or win participation on that project. As the economics team, though, we sort of take one step back, look at all that lovely data, and try and see where things are going to be moving over the next few years, really by delving into that data, putting it alongside macroeconomic, interest rates, that sort of thing, that sort of data, really to try and analyse what things hold for the market. And actually, you heard about the uncertainty from Alex that is in a lot of people's minds, and yes, that uncertainty is there. But I think actually for the first time in it feels like quite a while, despite that continued geopolitical uncertainty sort of on a global scale, actually in the UK, I think we are starting to see some green shoots coming forward, and we've actually got a brighter outlook than we've had for some time in our forecasts for the next 2 to 3 years. And I shall run through that in a moment. You can see from the overall chart there, first of all, you can see this is the value of individual projects that are starting on site each quarter. Inevitably, you can see the seasonality in that data. But I think more importantly, if you look at it, it's been a pretty static, flat picture, if that, over the last sort of 8 years, 5, 10 years. Actually, we're looking at a turnaround now. And we are expecting a strengthening in the value of projects starting on site. As I said, that's despite the geopolitical uncertainty, and it really reflects the fact we're looking at strengthening in UK domestic demand this year, particularly on the consumer side, and that's going to flow through into particular parts of the construction industry, which I'll go through into a little more detail. Not least, but first, if you look at the wider economic picture and the pressures that perhaps being faced in the market, you can see that actually one of the problems we've had over the last, going back a couple of years ago, was a very sharp rise in material prices. That's the chart there on the right. But we are looking at a more stable situation, at least for now. Clearly, the threat of Trump's tariffs, for example, are a potential threat to that stability, but they're probably stability on the downside as much as on the upside. For example, if steel gets diverted into the UK market that would have otherwise gone to the US, that's probably going to cause a softening in costs there. So in a lot of respects, I think we've got a bit more stability, but also perhaps not that much prospect of material price inflation. On the labour side of things, though, yes, there are pressures in the market, and they're likely to increase over the next few years, particularly as we anticipate, we see a strengthening in construction activity. As you can see, it's running around over 5% in terms of average earnings growth in the construction industry, very much as it is in the UK economy. And whilst that's a cost pressure, if you're looking across the wider economy, actually that's good news. It's not good news for us in terms of people being paid, but it's also good news in terms of what that means for construction, particularly, as I say, those consumer-related areas. And if we look at the residential side first, that's where we're starting to see the initial green shoots starting to flow through. This is our forecast for overall for the value of social and private projects starting on site over the next 3 years. You can see that from this year onwards, there's a strengthening in demand. And that's really being driven by, as I say, those macroeconomic issues. If we look at property transactions and mortgage approvals in the wider housing market and how they're fitting into the wider housing market and new housing as well, you can see that after a lot of volatility, we've seen a strengthening coming through in terms of the number of property transactions. There was a bit of an upturn in the first quarter of this year, final quarter of the last financial year, really sort of perhaps given an extra sort of a spur by the changes to stamp duty rules that came through in April. So there was a little bit of a rush of people trying to complete ahead of that deadline. That's now in place now. We did see perhaps a weakening in April, but things have moved around quite quickly in terms of property transaction. The housing market is looking a lot firmer than it has for some time. And that's being driven by two things. Firstly, you've heard a lot about the cost of living crisis, but actually, if you look at average earnings now, they are running ahead of inflation. People are starting to feel better off. Their financial position is starting to gradually improve. So that gives them a little bit more confidence, particularly given this against the background of also an easing in interest rates. They've already come down. There's a prospect of further easing in interest rates. And we've already seen an easing in mortgage costs, and lending criteria is in the pipeline as well, all of which bodes well for property transactions, are likely to increase activity in the wider housing market and in the demand for new homes as well. And house builders, you can already see that again in the inflation figures coming through, being tracked by the Halifax and Nationwide. You can see after the actual fall in prices during 2023, there's been stability and then a strengthening in prices. And that's likely to pick up further. We're looking at probably about 4 or 5%, I think is the general consensus in terms of rise in house prices this year. So that's going to give people a lot more confidence, and certainly it's giving house builders a lot more confidence. And in our latest data, we've already seen a strong rise in the value of private housing projects starting on site this year. And that's likely to flow through further as the year progresses. So house builders are really opening up new sites already in anticipation that we're going to see that strengthening in demand both in the second half of this year and as we go into 2026. And we anticipate that further momentum to continue over the forecast period. Turning now to the social housing side of things, where we have seen some additional support coming through for housing associations in last autumn's budget and the spring statement. That has helped to sort of stabilise activity in the social housing sector a little bit. And then we've now had the spending review as well, which has set out further commitment for additional, particularly over the longer term, support for the social housing sector. That's in terms of capital funding, but perhaps more fundamental has actually been they've also agreed, government's agreed that housing associations can increase their rents at 1% above inflation over each of the next 10 years. Now that gives housing associations a firmer financial footing and gives them and their lenders confidence, which means that they'll be able to drive more private sector money to fund developments in this sector as well. So again, a gradual brightening picture we anticipate over the next 2-3 years in this sector. The other area that's going to pick within this sector, which is in there for a bit of a quote, we had to put it somewhere, is student accommodation. Obviously, that's mainly privately sector-funded projects. And we've had a period of consolidation really from about 2018 onwards within the sector. We do anticipate a little bit of a pickup over the forecast period of new projects coming forward there. Clearly, the university sector generally and the flow of student and the requirements of accommodation being demanded by students is changing a little bit. One of the key drivers for this sector had been accommodation, particularly for overseas students who would typically stay in such accommodation for the full 3 years. I think the developments now are increasingly trying to roll that out as an opportunity for UK resident students as well, trying to squeeze out perhaps the buy-to-let investors that have traditionally operated and provided accommodation for sort of years 2 and 3. So increased competition there, I think really affecting the sort of change in the financial structure and profitability for buy-to-let investors, which is sort of causing them to exit the sector, throwing up new opportunities for purpose-built accommodation going forward. Moving on to the industrial and the commercial sector, where I think that disruption that we heard about from the global on a global geopolitical level, I think that is going to have something of an impact within this sector, and certainly in terms of investor confidence, it's going to delay a number of projects going forward. That said, whilst that might soften overall activity during 2025, we still anticipate renewed growth as we get in terms of projects starting on site as we get into 2026 and 2027. Now that's taking industrial and commercial sectors as a whole, but within that there's different movement within different sectors. So there are other opportunities that are coming through. If we look at the individual sectors perhaps in more detail, one of the brightest and first to perhaps recover is the industrial sector. As you can see from the chart there, it's been very much driven by warehousing and logistics demand in recent years, really on the back of the fact that we're buying more and more stuff online. It's interesting that obviously you can see a big spike in 2022, just as we came out of COVID, really reflecting the fact that during the pandemic we were just pretty well buying everything online, and that really helped us sort of boost investor confidence in that. Then it did kind of run away ahead of itself a little bit at that point. Clearly, people did return to the shops, but if you look at the online purchases as a proportion of retail spending, yes, it retreated post-pandemic, but it still remained above where it was prior to the pandemic, and it is now starting to rise again. So we can see further renewed investment, both from online retailers and third-party sort of distributors driving demand in this sector over the next 3 years. In fact, indeed, I think earlier this week, Amazon announced that it's rolling out something like £5 billion worth of investment, both in major hubs, but also in sort of smaller, more local distribution facilities. Other online retailers are available. So offices. Again, actually, this sector is starting to turn around. It's an interesting market in the sense that these are the data for the value of projects that have been securing approval. And you can clearly see there has been a softening in the number of projects that have secured approval in recent years, whether that's new build projects, which account for the bulk of them, or extensions or refurb-only projects. But if you compare that with what's actually been happening in terms of projects starting on site, you can see that actually the value of new build projects has been a much smaller part of the cake, so to speak. What we've seen has been a lot more investment going forward and a lot more projects going on forward to extend and refurbish existing projects, really to accommodate the change in working practices. The move to more hybrid working has meant that actually, if people are going to come into the office, they're going to have accommodation that's going to be a lot more collaborative space. So there's been a lot of refurbishing to accommodate that, subdivision, subletting of premises as well to reflect that changing pattern. So whilst overall perhaps office requirements have declined, the demand has changed in terms of what people are demanding from their office space. And interestingly, one of the things that they have been demanding is higher quality office space over the last few years. If you look at across the office property market, it's been the premium and high environmentally performing offices that have performed and held up well in terms of capital values and returns on investors. And I think that's going to investors, and that's going to be one of the things that's perhaps going to drive things going forward. We're certainly looking at our data, as I say, going back to that approvals. There's plenty of projects that have been securing approval in terms of new build projects, and we see that returning as a major driver for growth alongside continued refurbishment work over the next 3 years, with people particularly targeting premium office space with high environmental performance, really because that's what's being demanded by customers increasingly, and by legislative changes in terms of the ECG EPC certificates that are coming through, and that ratcheting up in requirements. So there's an overhang, potentially volume-wise, an overhang of office space facing the market. It's been the tertiary and secondary accommodation that's been particularly hard hit. So landlords, developers are looking at some of those sites, saying, can they be repurposed? Can we refurbish them, turn them into accommodation? Or do we start again and raise them to a much higher environmental standard where they're going to attract tenants? Less positively is the retail sector, and it's the flip side of that strengthening in retail sales. That side, we do expect to perform more weakly going forward, as there's a massive overhang of retail space. Something like 20% of retail space is vacant. So there's little demand for new build projects there. The one bright spot has been in the grocery sector, with continued investment by Aldi and Lidl, where they're rolling out a program of new store openings. We can see that continuing to drive the sector going forward. Certainly, in the near term, retailers generally are facing increased cost pressures, not least from the rise in labour costs, with the rise in the minimum wage and the increase in NI costs as well. So that's, again, dampening the funds available for investment. And it's a similar story in the hotel and leisure sector as well, which, again, is a sector that's very exposed to that increase in labour costs. We did see quite a sharp turnaround last year ahead of that, but I think we're expecting something of a period of consolidation in the near term. Beyond that, though, we do see a strengthening in demand coming forward again, not least going back to the consumer side of things, from that rise in consumer spending power, and particularly in discretionary spending that's going to come through, and it's going to give new opportunities for the hospitality sector and help renew investor confidence. Also potentially increase in overseas visitors numbers as we, again, continue to recover from and move back towards pre-pandemic levels, will throw up new opportunities in the hotel sector as well. So then from that, moving on to the sort of government-funded areas, where clearly we had the spending review just a week or so ago, setting out the government's longer-term plans there. And again, there we do expect, after a weakness this year, a gradual recovery going forward. And that weakness during the current year really reflects the fact that last year we had general election, where a lot of projects effectively were held up and delayed by the general election, then post-election by government review. But we are now starting to see the new government strategy starting to emerge, as they've got the spending review, we've got the forthcoming health statements, and we've got the transport and industrial strategies all emerging. And that's going to help lift investment, particularly as we get to the back end of the forecast period. Taking education, for example, that's been a sector that's been very much driven over the last year by investment across the piece, but particularly in areas such as school buildings, where from 2023 we saw a sharp increase in funding provided by the last government, in large part to deal with RAC and the issues that was related to that. The new government is obviously continuing to press on with investments in that area, but they've got this program of 500 refurbished, rebuilt schools. They're pressing on with that program as well. And there is additional funding that has been provided in the spending review, which should enable them to provide the resources to allow the local authorities to continue and press on with that investment. So we've got a gradual recovery there during 25, 26, and going into 2027 in terms of schools and FE colleges. Universities, which have been a major driver and important element within this sector, did pick up a little bit post-pandemic, but we really have a very cautious view over the next few years. Clearly, whilst we've seen a small increase in the fees that universities can charge UK resident students, it's really not tying up with the fact that they've been 10 years of no increase. So their finances on that front remain under a lot of pressure, plus there's increased restrictions on overseas students, which has been the major additional source of funding available for universities. As a result of that, I think given the financial pressures they're under, we see very little new investment coming forward in terms of university facilities. The health sector, clearly health remains a major government priority. Wes Streeting yesterday was sort of preparing the ground for his 10-year strategy for the NHS. And whilst we see sort of a progressive strengthening and recovery in investment in health, it's not going to be a huge surge of investment. Certainly, I think what the Secretary of State does seem to be indicating is a shift of priorities. So, yes, there will be some more investment in new hospitals and facilities there, very much, I think, targeted on areas of particular deprivation, but it's also very much more of a focus on prevention. So a lot more resources perhaps going into the primary healthcare sector rather than into new hospitals. And then civil engineering, which, again, I think is looking much brighter. Whilst our forecasts themselves look at underlying project starts, so looking at the general market conditions, so we exclude projects under 100 million, they only make the point in civil engineering, there's an awful lot of projects above that threshold. And across both those major projects and the underlying market, things are looking a lot brighter than they have for some time. There was additional resources, again, provided through the spending review, particularly for transport. We've seen sort of a recommitment to investments such as the investment in the sort of the north of England, improving connections there, particularly on the transport side, rail side of things, and the Lower Thames crossing in the UK, in Kent as well, is a major project that they've already announced. I think something like £1 billion worth of government support. They just need the other 14 billion of private sector funding to take it forward. So there's a bit of a funding gap there, and that's clearly going to be sort of a public-private financed project to deliver, which is intended to strengthen and improve UK productivity across the country by improving transport connections with the continent. Alongside that, though, I think it's the utilities side in terms of investment in renewables, the connecting of the grid to those new generating sources, and investment in the water industry, something like £108 billion worth of investment. We've already seen a sharp rise in our water bills from April, and that really is to fund increased investment in improving water quality, as well as new reservoirs and stopping leaks and so forth. Clearly, the water industry over the last few years has come under increasing pressure and scrutiny and perhaps public division. I think the new government and the regulator are going to be looking very carefully at the industry, given those sharp increases in funding, to make sure that actually that money is flowing through as investment. So I think, by and large, I think a very positive picture going forward. So if you look at the overall picture here, you can see the initial trends. So the residential sector is where we see the first and earliest signs of recovery and a strengthening pattern of growth throughout the forecast period, really very much driven by that strengthening in consumer spending and confidence. Industrial and commercial, yes, it's brighter as well, but recovery delayed a little bit. Strongest growth is in 2026. Whereas the public side, public sector side, in terms of public building, we've got that drop in activity anticipated this year, really a hangover from the sort of delays, reviews and everything that were happening in 2024, before we see a modest recovery from next year's onwards. But overall, as I say, we're looking at a much brighter picture than we have for some time. Regionally, you can see there's perhaps a focus towards particularly the Midlands and the north of England. They're likely to be the strongest performing areas over the forecast period. To a certain extent, that reflects the product mix in terms of greater exposure to the housing market as a proportion of all construction activity in those regions. So that benefits from the rise in private housing activity. but also in terms of government policy, in terms of focus of resources on sort of both in terms of industrial strategy, but also in terms of what they're trying to do on the social front and investing there going forward. So very much, again, those parts of the country where they're trying to sort of, they've gone away from saying levelling up now. That was the last crew, but effectively that sort of support for the regions. And overall, as I say, a much brighter picture than we've had for some time. So whilst we saw a decline in project starts in 2023 and a pretty flat picture last year, we're actually looking at a return to growth this year, very much driven by, as I say, initially by the housing sector, but much more widespread and robust growth in 2026 and 27, getting into double digits overall. So a much more positive picture, as I say, overall. Thank you very much.